For thousands of years, there's been one asset that has stood above all others as the symbol of financial security: gold. It's been the bedrock of wealth, the ultimate store of value, and the safe harbor in any economic storm you can imagine. But what if I told you its reign might be coming to an end? What if the very definition of a safe asset is being rewritten right now on a global digital ledger? There are whispers in the market, quiet movements of huge amounts of capital that suggest a historic shift is underway, a silent financial revolution. Now, the mainstream headlines can be confusing. You see gold hitting spectacular new highs while Bitcoin goes on its own gut wrenching roller coaster ride. Many will tell you the old ways are still the best, but the data, when you look closely, tells a different story. It points to the beginning of what could be the single greatest wealth transfer in modern history: the rotation from gold to Bitcoin. In this video, we're going to expose the numbers, analyze the money flows, and uncover what's really driving this tectonic shift. This isn't just a story about two assets, it's about a new financial world being born, and understanding what's happening could be critical for the future of your wealth. So let's get into the evidence. If you've been following the financial news in 2025, you're probably thinking, a rotation from gold? That can't be right. And on the surface, you'd have a point. This year has been nothing short of spectacular for the yellow metal. We've seen gold shatter one record after another, surging past $4,000 an ounce and even touching levels around 4,360. At its peak, this rally represented its strongest performance in decades, with year-to-date gains hitting around 38%. So what's driving this? The reasons are pretty clear: geopolitical uncertainty, stubborn inflation, a weakening US dollar, and fears of a stock market downturn have all created a perfect storm for gold demand. And who's been leading the charge? The biggest players in the game: central banks. Institutions like the People's Bank of China have been on an unprecedented buying spree, reportedly accumulating gold for over 18 consecutive months. Countries like Poland, Turkey, and India have also been aggressively upping their gold reserves, using it to hedge against currency swings and reduce their reliance on the dollar. This isn't just speculation, this is a structural shift by some of the most conservative financial institutions in the world. They're sending a clear signal. In an uncertain world, they trust gold. The money flowing into gold-backed exchange-traded funds, or ETFs, tells a similar story. Throughout 2025, gold ETFs have seen massive inflows, and for significant periods, they outpaced their Bitcoin counterparts. While specific figures are hard to pin down, the trend is clear. In 1 week alone, the two largest gold ETFs reportedly brought in over $4 billion in new assets, showing just how ravenous the institutional appetite has become. At the same time, Bitcoin's journey in 2025 has been a roller coaster. After a strong start, the momentum seemed to cool off. The initial hype around the spot Bitcoin ETFs in the US, while still incredibly successful with nearly 19 billion in cumulative flows, began to settle down. The price hit impressive new highs, peaking over $110,000, but it also saw sharp corrections, at times dipping back toward the $100,000 mark. While big players like BlackRock and MicroStrategy kept making headlines with their Bitcoin buys, the overall flow of capital seemed to favor the age-old security of gold. So, if you just look at this short-term picture, the great rotation narrative seems dead on arrival. In fact, it looks more like a great rotation to gold. But this is where the story gets interesting. What this surface level view misses is the fundamental rewiring of the financial system happening just beneath. The 2025 gold rush isn't a rejection of Bitcoin, it's the final frantic gasp of an old system waking up to the fact that its foundational assets are failing. The demand for both gold and Bitcoin is a symptom of the same disease: a crisis of faith in government issued currencies and bonds. Investors aren't just looking for a temporary safe haven, they're starting to search for a new foundation altogether. And while gold is the familiar answer, Bitcoin is shaping up to be the inevitable one. The data shows this isn't a simple one-way street. It's the beginning of a great diversification, where Bitcoin is systematically being added alongside gold, setting the stage for an eventual rotation. Let's look at the mechanics that make this shift not just possible, but probable. To understand why a rotation from the oldest money in history to the newest is even on the table, we have to start with the single most important trait of a store of value: scarcity. This is gold's whole claim to fame. Its value has always been based on the simple fact that it's hard and expensive to get out of the ground. You can't just print more of it. This physical limit is what has made it such a reliable hedge against the debasement of fiat currencies. When governments print trillions, the value of each dollar goes down. Gold, being finite, is supposed to hold its value, but this very principle is now being challenged. not because gold has changed, but because we've discovered something that is quantifiably better. Let's break down the real difference in scarcity here. Gold supply, while hard to increase, is not fixed. It grows by about 1.5% to 2% every year through mining. The truth is, we don't know how much gold is actually left in the Earth's crust. We don't know what new mining tech or even asteroid harvesting might do to the supply in 50 or 100 years. If a massive, easy to reach deposit were found, the supply could shoot up, diluting the value for everyone who owns it. Gold's scarcity is based on assumptions, which can change. Now compare that to Bitcoin. Bitcoin has a supply cap that is absolute, transparent, and enforced by math on a global decentralized network. There will only ever be 21 million Bitcoin. That number isn't an estimate. It's written into the code for anyone to see and verify. It can't be changed unless basically everyone on the network agrees to it, which is practically impossible. This makes Bitcoin supply the most predictable of any asset in history. This isn't just a theory, it has huge real world implications. We know exactly how many new Bitcoin will be created in the next 10 minutes, tomorrow, next year, and in 2140 when the last fraction is mined. This schedule is driven by the halving, where roughly every 4 years, the reward for miners gets cut in half. This process automatically slows down the creation of new supply, making Bitcoin scarcer over time. It's a monetary policy set in stone, free from the whims of any central bank or government. Think about what that means. Central banks are buying gold to protect against the dollar losing value, but gold itself has its own form of inflation, that slow, steady increase in supply. Bitcoin offers the final escape from this problem. It's the only asset in the world with a perfectly inelastic supply. No matter how high the price goes, no matter how much demand there is, we cannot create more of it faster. This idea of verifiable scarcity is what makes Bitcoin a revolutionary leap past gold. While gold's scarcity is physical and uncertain, Bitcoin's is digital and certain. It's the difference between a strong guess and a mathematical fact. This is why calling it digital gold is both a brilliant starting point and a massive understatement. It's brilliant because it connects Bitcoin to the familiar idea of gold's scarcity. But it's an understatement because Bitcoin's scarcity is absolute. In a world drowning in debt and endless money printing, investors are starting to realize that the quality of scarcity matters. And as they search for the hardest store of value, they are increasingly being led from the physical scarcity of gold to the absolute scarcity of Bitcoin. This isn't a matter of opinion, it's a matter of code. If absolute scarcity is the why of the rotation, then Bitcoin's superior real world properties are the how. For an asset to work as global money, it can't just be scarce. It also has to be easy to hold, move, and trade. For thousands of years, gold was the best option we had, but being a physical object comes with huge limitations, limitations that Bitcoin completely obliterates. Let's start with portability. Imagine you need to move your life savings across a border. Your wealth is in gold. How do you do it? $1 million in gold weighs about 40 pounds. $10 million is 400 pounds. $1 billion, 20 tons. It's heavy, expensive to move, and almost impossible to hide. You need armored trucks, vaults, and guards. Every step adds risk and cost. Now, imagine that same $1 billion is in Bitcoin. It exists as information. You can store it on a device the size of a USB stick. You could even just memorize a 12 or 24 word seed phrase, a password that gives you access to your Bitcoin from anywhere with an internet connection. You could walk across any border with $1 billion stored only in your head, and no one would have a clue. This level of portability and financial freedom has never existed before. Bitcoin is weightless wealth, and this isn't just for the super rich. It's a game changer for anyone who values control over their own property. When you hold your own Bitcoin keys, no bank or government can freeze or seize your assets without your permission. It's the digital version of holding a gold bar in your hand, but without the risk of someone physically taking it from you. This seizure resistance is a powerful feature in a world with growing capital controls. Next, think about divisibility. It's hard to chop up a gold bar to buy a cup of coffee. Bitcoin, on the other hand, is designed for the digital world. Each Bitcoin can be divided into 100 million smaller units called satoshis. This means you can send tiny fractions of a cent, making it perfect for the kind of micropayments and global commerce that gold could never handle. Finally, there's verification. Checking if a gold bar is real requires special equipment and experts. Counterfeits are a real risk. By contrast, Bitcoin transactions are verified by thousands of computers all over the world. Once a transaction is confirmed and added to the blockchain, it's there forever. It can't be faked or reversed. These features aren't just small upgrades. They represent a total transformation in the technology of money. Gold is a store of value for an analog world, slow, heavy, and stuck in one place. Bitcoin is a store of value built for the internet, fast, weightless, and borderless. The rise of Bitcoin ETFs is the first major bridge connecting the old financial world to this new one. ETFs let people buy Bitcoin in their normal brokerage accounts, which is a great first step. But the true power of Bitcoin lies in owning it directly. As more investors get comfortable with it, many will move beyond just owning an ETF to holding the asset itself. Why own a paper claim on something when you can own the real thing with all the freedom it provides? The rotation from gold to Bitcoin won't happen because people fall out of love with gold. It will happen because Bitcoin is simply a better technology for doing the same job in our modern world. Gold's physical limitations, once a feature, are now a bug, and capital, like water, always flows down the path of least resistance. For any new asset to challenge an old giant like gold, it needs two things: legitimacy from the establishment and adoption by the next generation. In 2025, both of these forces are accelerating and creating a powerful feedback loop for a massive reallocation of capital. First, let's talk about the institutional stamp of approval. For years, Wall Street dismissed Bitcoin as a joke. That story has been completely flipped on its head. The game changer was the approval of spot Bitcoin ETFs in the US in early 2024. This was a green light from the top of the US financial system, giving everyone from hedge funds to financial advisors a regulated and insured way to invest in Bitcoin. And they did. BlackRock, the world's largest asset manager, didn't just launch a Bitcoin ETF. Their CEO, Larry Fink, has publicly called Bitcoin an international asset and a hedge against currency devaluation. This isn't a short-term trade, it's a long-term strategic decision from the biggest player in finance. This institutional embrace is creating a flywheel effect. ETFs create liquidity, which reduces volatility, which then attracts even more big investors. One recent survey showed that 67% of institutional investors expect Bitcoin's price to keep rising, and a growing number of public companies now hold Bitcoin on their balance sheets. The shift from a speculative gamble to a strategic reserve is the most important psychological milestone in Bitcoin's history. But that's only half the story. The other, arguably more powerful driver is a huge demographic shift. For centuries, gold was passed down from one generation to the next. But what happens when a generation comes along that grew up in a digital world? Younger investors, from millennials to Gen Z, are digital natives. For them, an asset that's just code, secured by math, and accessible from anywhere on Earth isn't weird. It's intuitive. The idea of digging a heavy metal out of the ground just to bury it in a vault seems, by comparison, a little old-fashioned. This isn't just about taste, it's about where trillions of dollars are about to go. Over the next couple of decades, we'll see the largest transfer of wealth in history as baby boomers pass on their assets. A huge chunk of that money is going to land in the hands of people who see Bitcoin not as a risk, but as the default safe haven for the digital age. Even a tiny allocation of this inherited wealth away from traditional assets like gold would have a massive impact. Analysts have pointed out that because the gold market is so massive, estimated at over $13 trillion, a shift of just 3 to 4% of that capital into Bitcoin could be enough to double Bitcoin's price. This isn't a fantasy, it's just math. So you have a two-pronged movement chipping away at gold's dominance. From the top down, you have the world's biggest financial institutions building the plumbing for trillions to flow into Bitcoin. And from the bottom up, you have a generational tide of capital that will increasingly favor the digital over the analog. The rotation won't be a single event, but a gradual multi-decade process. And all the evidence suggests that process has already begun. Okay, but let's be honest and talk about the risks. No credible case for Bitcoin can ignore the powerful arguments that still favor gold. Believing in the rotation thesis doesn't mean being a blind Bitcoin fanatic. It means you've weighed the pros and cons. The biggest argument for gold is its 5,000-year history. It has survived fallen empires, world wars, and countless financial crises. Bitcoin, on the other hand, is still a teenager. It's a technological experiment that hasn't truly been tested by a generation-defining global crisis. For many conservative investors and central banks, that long, proven track record is non-negotiable. The second, and most obvious, is volatility. Bitcoin's price swings are legendary. While the long-term returns have been incredible, the volatility makes it a tough pill to swallow for anyone looking to simply preserve their wealth. Gold, by contrast, is known for its relative stability. It doesn't promise wild gains, but it offers a much smoother ride. Then there are the regulatory and tech risks. While ETFs have brought clarity in the US, the global rulebook is still a mess. A coordinated crackdown by major governments, while less and less likely, is still a possibility. On the tech side, while the Bitcoin network has worked perfectly so far, there are long-term theoretical threats, like the development of quantum computing that could challenge its encryption. These are low probability events, but they aren't zero. Finally, there's the argument that this isn't an either or situation. Many smart investors would say the right move is to own both and. In this view, gold is the stable bedrock of a portfolio, while Bitcoin is the high growth, tech driven hedge against inflation. The fact that both assets rallied in 2025 supports this great diversification idea. So, how do we square these valid points? While Bitcoin is young, it has already survived multiple brutal market cycles, emerging stronger each time. Its value isn't based on history, but on math, which is arguably a more timeless foundation. As for volatility, that's a common feature of any new asset class finding its true price on a global stage. As Bitcoin's market cap grows, its volatility will naturally decline over time. Regulatory risk is fading every day as more institutions and even countries integrate Bitcoin into their financial systems. And the tech risks are constantly being worked on by thousands of open source developers who are financially incentivized to keep the network secure. The argument for holding both is probably the most realistic. A sudden 100% rotation from gold to Bitcoin isn't going to happen, but the logical conclusion of a both strategy is a gradual shift at the margin. When an investor decides where to put their next dollar for safety, Bitcoin's superior properties and higher potential upside make it an increasingly attractive choice over gold. Over time, that small decision, repeated millions of times, is what will drive the rotation. So, where does all this leave us? The headlines in 2025 paint a confusing picture. Gold is having a historic moment with central banks and big investors piling in. By all appearances, gold's throne looks pretty secure. But when you look deeper, a more profound truth emerges. The very things driving people to gold, fear of inflation and instability, are the same things that are, for the first time, giving them a superior digital alternative. The Great Rotation isn't an overnight event. It's the beginning of something more subtle and powerful, the Great Diversification. We've seen that Bitcoin isn't just digital gold. Its absolute verifiable scarcity is mathematically superior. We've seen that its digital nature makes it a store of value perfectly engineered for the internet age, weightless, borderless, and sovereign. And we've seen the twin engines of institutional adoption and generational change building the demand for a multi-trillion dollar shift in the decades ahead. The debate is no longer about whether Bitcoin will survive. The debate is now about allocation. The world's largest asset managers and an entire generation of digital natives are starting to add Bitcoin to their portfolios, right alongside gold. This is the quiet revolution. It's the decision made every day to allocate a small piece of wealth to the absolute scarcity of Bitcoin. Over time, these small decisions will compound into a seismic shift. The 2025 gold rally isn't the dawn of a new era for gold. It's the last great echo of an old one. The future of hard money is digital. The rotation has begun. This is one of the most important financial stories of our lifetime, and it's just getting started. If you want to keep getting data driven analysis on this historic shift, make sure to subscribe. The landscape is changing faster than ever, and you won't want to miss what comes next. What do you think? Is the rotation real, or is gold's dominance here to stay? Let me know in the comments below.